Hello students, this video will take you through exercise 5-25 on page 166 of your workbook. In this exercise, we're continuing the record keeping for Canoe Company, and we have some information related to their merchandising transactions. This company uses the Perpetual inventory system. A reminder that what that means is that inventory is updated every time there's a change, including when there is a sale. All right, we're going to do each one in turn, and I'm just going to put the answers into Excel so you can see me type them as we go. All right, so our first entry happens on January 1st. 10 t-shirts are purchased at $4 each, and the company paid cash. We're going to debit the inventory account as the amount of inventory has increased, and we're going to credit cash. The amount will be the price that was paid, which is $4, times 10 t-shirts. On the next transaction on January 2nd, we are now selling 6 t-shirts for $10 each, and we've been given the cost in the question, and we're told that we receive cash. Cash is an asset, which means that if we receive it, it has to go up with a debit, and if we sell t-shirts, what that represents is revenue. In this case, we'll call it sales revenue. The value will be calculated as $10 times each of 6 t-shirts. So the sale value here is $60 each. Now we're not finished. Because we're using a perpetual inventory system, we are required to update inventory every time a sale is made. So we now have 6 t-shirts that are leaving our inventory. We record that as a credit to inventory to reduce it. Remember, assets reduce with credits. And our debit is to a new account called Cost of Goods Sold. This account is used for merchandising companies to help record the expense of the items. In this case, it was a $24 charge that was provided to us in the question. All right, let's take a look at the next transaction. On January 3rd, the company purchased 50 t-shirts on account at $5 each, and we've been given payment terms. Whenever you're given payment terms, you should realize that that means it is on account. Payment terms are not offered for cash sales. This question also clearly states that the purchase was on account. So what that means is that we are receiving inventory. This is an asset account that will go up with debits. The value that we're going to be buying is 50 t-shirts times $5 each. So $250 worth of inventory. The way that we're going to pay for this is on account. So we record accounts payable. On the 7th now, our next transaction, we're paying the supplier for t-shirts posted on January 3rd, less the discount. You should be able to figure out whether or not the discount applies based on the number of days that have passed. So if the sale happened on the 3rd, and the payment happens on the 7th, and our terms are 2/10 net 30, that means if we pay in 10 days, we're going to get a 2% discount. Well, we are paying within 10 days. We're paying by the 7th, which is quite quickly, which means the amount that we're going to pay will be less than the amount we owe. So on January 7th, we record a transaction where we pay cash. The amount of cash we're going to pay is the $250 that we owe minus a 2% discount. Now there's a few ways you could calculate this. You could calculate the sale price being $250, calculate the discount as equal to 2%. Now remember, a percentage is a decimal point, so 0.02, which gives us the net amount, 250 minus 5. So we're going to pay $45. Another way to do this is you can actually calculate it as the amount owed, $250, times 1 minus the discount rate. Either way that you go about it is fine, as long as you're able to come up with the amount of cash that's paid. When we make that payment, our entire account payable will be eliminated, so that full $250. And if you look at what we've got here, we have a $250 debit and only a $245 credit, which means that we have a $5 amount that is required in order to balance this journal entry. Now, with a perpetual inventory system, what we're trying to do is keep the inventory account updated. And when we get a discount on payment, what that is a reduction to inventory. So we will reduce the inventory value by $5 with a credit. Next, on the 8th, we realized that 4 t-shirts from the January 1st order were printed incorrectly and returned for a cash refund. So we have to go back and look at the January 1st order. At the January 1st order, we can see that we paid $4 for each of those shirts. So when we return them, we should get the $4 back. So January 8th, we're going to we're going to credit cash because we're going to receive money back, and we're going to debit inventory by the amount that we are reducing our inventory. Now, how many was it? According to the question, 4 t-shirts. So 4 times $4 each means that we are returning $16 worth of t-shirts. We debit cash $16 and we credit inventory. All right, let's see what other questions we have. Now, January 10th. We sell 40 t-shirts on account for $10 each, and we've been told that the cost of those t-shirts is $200, and the terms of sale are 3/15 net 45. That means that if the person pays us within 15 days, they will receive a 3% discount, and the net is due in 45 days. If they pay beyond the 15th date, they will not receive the discount. Now this says that the sale was on account. An account, from the perspective of a sale that we have made, is called an accounts receivable. That's an asset account that shows that somebody owes us money. So we're going to debit the asset accounts receivable equivalent to the amount of the sale. 40 t-shirts times $10 each. Our credit, as always, is to sales revenue. Now we're not finished. Because we have a perpetual inventory system, we also have to record the cost of goods sold, which is an expense account, which must be debited, and a credit to inventory, showing that those t-shirts have now left our inventory. The total value of the goods is $200, as given in the question. Now, on the 12th, we're receiving payment for the t-shirts that we sold in account on January 10th. That was only 2 days. Remember, the terms were 3/15 net 45. This means that the people who are paying us will receive a 3% discount. And again, we can figure out the amount. So the sale was for $400. The discount was 3%. And to calculate what that is, we would take $400 times 0.03. So the discount is equal to $12, which means that the net amount that they will pay will be the $400 minus the discount of 12. So the amount of cash we're going to receive is only $388, despite the fact that the amount owing was originally $400. So we record cash equal to $400, but our credit to accounts receivable must be for the amount of cash is $388, and the credit to accounts receivable must be for the full $400, so that they have nothing remaining. When you look at this entry, the debit side has less than the credit side, and we know it needs to balance. The difference is the amount of the discount. So then the question is, what account would we use to record a discount? We could debit sales revenue, but if we did that, then the discount would get lost, and we wouldn't have any way of knowing. So in accounting, whenever we are trying to keep track of something, typically we create a contra account. We create a contra account here called sales discounts. And if you were to look at your income statement, what you would see is sales revenue. And I'm just going to give an example for this question alone. Sales revenue of $400 less sales discounts of $12, which would leave us with a net sales figure of the amount we received, $388. Now management can tell how much the original sale was for and how much was received in discounts. Now on the 14th, we're purchasing more t-shirts. And the amount we're buying is 100 t-shirts at $4 each, and we've been given these terms. If we're given terms, that means we're buying on account. So what we're getting here is inventory, which is an asset, and the way we pay for it is on account, accounts payable. The value will be 100 t-shirts times $4. I'm just moving it ahead so we can see the next question. All right, so we're on to January 18. On January 18, Canoe Company contacted the supplier from the January 14th purchase. So we're going to have to actually look back at that last purchase. That was the one we just entered with terms that were 4/15 net 30. We contacted the supplier and said some of the shirts were the wrong color. And so the supplier says, you know what, I'm going to give you an allowance. What that means is they don't want you to ship the shirts back. Instead, they're just going to give you a discount and ask that you keep the shirts. What that does is it reduces the cost of inventory we have on hand. So we're going to record this reduction as a reduction to accounts payable. The reason it's not getting paid in cash is because it was already an outstanding account, and the amount that it will be reduced is $50. This reduces the value of inventory. So we're going to credit the inventory account equivalent to the amount of that allowance. Now on January 20th, we're going to pay the supplier for those t-shirts. Remember that our discount terms were 4% if paid in 15 days. And since the original purchase happened on the 14th, we are definitely within the discount period. But some things have happened. The original purchase was for $400. Then we got an allowance that reduced the amount owing by $50, which means the amount currently owing, our outstanding account payable, on this is only $350. But we further have a discount of 4% because we're paying in time. So if we find out what 4% is, that's a $14 reduction. So the payment amount will only be $350 minus 14. We're going to pay $336 towards this outstanding debt. And once we do that, our entire debt will be cleared. So our entire debt will be cleared, which means the amount that we have to debit our account payable is $350. That's how much the company says we still owe. But the amount of cash that we're paying is only $336. The difference between the two is this purchase discount. When we have discounts on sales, we record them in a contra account because we want to pay attention to them. But when we have discounts on purchases, we simply record them as a reduction to inventory. So it's a credit to inventory of $14. Then, on the 21st, we have another transaction. We sell 60 t-shirts on account for $10 each. And then we've also been given the cost. Whenever you see total cost, what they're telling us is how much the value of the inventory was. The sale is based on the price that we sell it for. So we know that this is on account, so we're going to say accounts receivable, our asset, goes up by the amount of the sale. It was 60 t-shirts times $10, which means it's a $600 sale, and we record that as revenue. So our credit again is to sales revenue. Because we have a periodic inventory system, we also have to update cost of goods sold and reduce inventory immediately. And the amount of that is $220 as given in the question. Remember to do both parts. We have to first record the sale and secondly, reduce the value of inventory and record the expense. Next, on January 23rd, we are getting paid for these shirts that we just sold. We only sold them on the 21st, so it's quite a quick payment, and our terms were 2/20, 2% off if paid in 20 days. So that means the people who purchase these shirts are going to get the discount. The original sale amount was for $600. The discount is 2%. So if I multiply the $600 times 0.02, I can tell I get a $12 discount. So the payment amount will be the discount subtracted from the original sale value. So that is the amount of cash we're going to receive. We're going to get $588 cash, and when we do that, our entire accounts receivable balance will be eliminated because we do not expect to collect that additional $12. We're telling them it's a discount, they don't have to pay it. Now, because this is a sale transaction, we record it in a contra account called sales discounts. We've got a few more transactions left. On the 25th, we buy some more t-shirts. So January 25, we buy them on account. So we're going to have an debit to inventory and a credit to accounts payable. Now I know I have to debit inventory because it's an asset, and that's how assets increase. The amount is 320 shirts times $5. So this is a $1,600 purchase. And they've told us that it is FOB shipping point. What that means is freight on board shipping point, which means that these items become our property at the point that they are shipped. The terms are 2/10 net 30, so as long as we pay within 10 days, we're going to get 2% off. Now, because it was FOB shipping point, what that means is we have to pay the freight. And since if it doesn't tell you what method you use to pay, you can assume that it's cash. So we're going to pay $48 of shipping. Now, a lot of people think, okay, well, I'll record a freight expense. However, with inventory, remember that you want your inventory to be valued at whatever price you had to pay to get it ready for sale. And freight is actually part of the cost of inventory. So instead of debiting a freight expense account, we're going to debit inventory. We're increasing the value of the items in inventory by $48 because of this freight. Now, on the 29th, we're going to pay for the January 25th purchase less the discount. We know that we get the discount because we're paying within 10 days, and the amount of the discount is 2%. But be careful. Freight is completely unrelated to that transaction, other than it adds to the value of inventory. We're not going to get a 2% discount on our freight. Instead, we're going to get it on the original purchase. So if our original purchase was $1,600 and the amount of the discount is 2%, we can calculate the dollar value by taking 1,600 times 0.02. So we get a $32 discount on this transaction by paying early, and the amount we're going to pay then is the difference between the original price minus the discount. So now we have all the pieces, we can put it into our journal entry. So January 29th is the date of the payment, and we're going to have our full accounts payable balance eliminated. That's $1,600. We're only going to pay $1,568. And that $32 difference is a savings that we get by paying early. And as I've said before, that goes direct to inventory. Inventory gets increased by the cost of freight. It gets decreased by any discounts that you receive for early payment. We have 2 more entries to do. On January 30th, we sell 275 t-shirts on account, and we're given the cost again. Remember, the revenue is based on the selling price times the number of items sold. The cost is being provided in the question. So it's on account. I know that because there's terms and it says. So I've got an accounts receivable equal to 275 times 10, $2,750. Our revenue amount is the same, a credit to sales revenue for $2,750. However, we're not finished. We also have to record the cost of goods sold and the reduction in inventory. And these amounts were provided in the question. You've heard me talk before about gross margin or gross profit. That is the difference between the selling price and the cost of goods. So in this example, our gross profit is the difference between the selling price, which in this case worked out for the total order to be $2,750, less the cost of goods sold of $1,300. So that $1,450 is called our gross profit, which is how much is left over after paying for the cost of goods. Companies want to make sure that's a positive number. The final entry is on January 31st, where we received payment for those January 30th sold t-shirts. The terms were 2/10 net 30, which means that they have achieved a 2% discount because they've paid it within 10 days. And again, the original sale was for $2,750. The amount of the discount is 2%. So if I calculate the price times 2%, I can find out that they're going to save $55 by paying early, and the amount they're going to pay us will be the difference between the original price and the discount we're offering. So we are going to receive cash in the amount of $2,695, and that is going to eliminate their outstanding debt. So we will credit accounts receivable by the full amount. Notice that on the debit side I have less on the debit side than I do on the credit. So that $55 discount has to go here. Now, in this case, inventory has already been recorded. Remember when we recorded it as a credit on the sale? This is not a reduction to inventory, but instead it is an entry to sales discounts, which again is a contra account to revenue that would be showing up on your income statement before net sales. Thank you for listening.